Hi, I'm Travis Stitt, and welcome back to Metrics Matter. So, just like all the other metrics, let's ask ourselves another question. And let's ask ourselves, how do I know if I'm making the correct amount of profit? And the way you do that is something called a profit margin. The very dry technical definition of it is basically the financial ratio that measures the percentage of profit earned by a company in relation to its revenue. We're going to dive into that. That's a little dry. But the general idea is you want to measure this monthly to understand how much money you're spending in order to make money. So what should your profit margin be? Well, that kind of depends on what kind of business you operate. If you look online and you look at some of the national measurements, it basically says for a small business, anywhere between 4 to 10% profit margin is considered a good number. Now, with that being said, it really is industry by industry base. As you start to do more research into this, you'll realize things like restaurants operate around a 4 to 5% profit margin, while basically tech or service businesses can offer and basically operate at almost a 40% profit margin. PPA has some phenomenal materials when it comes to profit margin, and what I generally recommend is don't operate or yearn to make sure you're not operating below a 25% profit margin. This is indicating that for every dollar you bring in, you're making enough money and enough profit out of that dollar to make sure that you can, well, take a paycheck home, but also keep the business operating over a longer period of time.